and welcome back to yet another exciting week on the stock market. Actually, it's 2 exciting weeks on the stock market since I missed my update last Sunday, and as you can hear from my voice, it was due to the fact that I was sick. It was not with the COVID, it is with some sort of other virus, since I have been tested negative. So sorry for not uploading an episode last week, but I will try and make up for it in this week's episode, where I will mostly cover some of the news which we talked about in the last video, since I said I would be looking so much forward to seeing the quarterly results from some of the big banks in the States. But before we dive into the financial news, I really want to highlight this picture. Look at the graph down here and where we currently are. We are seeing these numbers increasing so rapidly. Actually, we haven't seen a growth rate like this ever before during this situation. And if we focus more on the States, it is all over here. And you can see that the number of confirmed cases, it's astonishing to see how this is spreading and how this is growing. So this is by far the most important news still to follow. I know that I have been downplaying it a little or not focusing on it in my episodes, simply just because I wanted to cover different topics. But this is the main topic every week currently. How is this disease evolving throughout the world? So with that situation in the back of our minds, let's take a closer look to the quarterly results from the big banks. We start by taking a closer look at JP Morgan here. We see that the GAAP earnings per share, they beat the estimate. They also beat on revenue. And then we see that they have put more losses aside for future purposes, more than the analysts have expected. So they are bolstering up, being ready to handle whatever situation they have to deal with. And of course, this was a very positive news for the stock market, since they were beating all the estimates, meaning they are doing better than expected, and we are still seeing that they are preparing for even worse times and they have the capital to do so, meaning that they should be capable of dealing with the current situation, even if it gets worse. So we can see that shareholders are rewarding, and JP Morgan gained more than 4% on that particular day, meaning 14th of July. If we then scroll down, we can see just a more detailed picture about consumer and community banking and stuff like that. Simply looking through all the details here, what I'm focusing on here is the CET1 ratio, meaning that they are putting more capital aside in order to deal with whatever situation, which is really important in the current market, since they themselves mentioned that there is a huge uncertainty for how the consumer in the States will do in this current environment. And if you're not familiar with CET1 ratios or Tier 1 capital, I'm not going to explain it here, since that could actually be a video of its own. I will just leave a link in the description below for Investopedia, where you can go and read more about it for yourself, since I think it would be too cumbersome to try and explain in this video. The only thing which I will highlight is that a CET ratio of 12.4% is really good, since the requirement by law is 4.5%. So just to put it into perspective, they are really well capitalized. If we then continue our journey and take a closer look at Wells Fargo, there we see a completely different pictures. They are missing all the targets set by the analysts. So GAAP earnings per share and revenue, and shareholders are not rewarding this. We even see that Wells Fargo has cut their quarterly dividends down to 10 cents per share, meaning that they have cut the dividend by 80%, since the previously whole dividend was 51 cents. And I think that the stock actually dropped around 7% on that day when this was announced. If we then continue, then we see that Bank of America looks much more like JP Morgan, since they are beating GAAP earnings per share, and they're beating on revenue, and we see that they are also increasing the reserve build, not as much as JP Morgan, but nonetheless still also a really good result by Bank of America here. And apparently I'm not the only one who thinks that Bank of America has actually turned in quite a good quarterly result, since my favorite investor, Warren Buffett, Berkshire Hathaway, is adding $816 million worth of Bank of America stocks to their portfolio. So now they own 11.4% of the company, meaning that they have scooped up 34 million shares of Bank of America with around an average price of $24. And I actually think this is really interesting, since if we go around 2 months back, when I made episode 18, I talked about why Berkshire Hathaway was selling Goldman Sachs stocks, and now we are seeing this big purchase in Bank of America. So he has clearly shifted his focus from one bank to another. And I mean, when we see the quarterly result from Bank of America, I'm really happy about that. And I still think that the reason why he sold Goldman Sachs is still valid for why he don't want to hold it going into this uncertain future. So if you missed episode 18 for why he sold Goldman Sachs stocks, then I would highly recommend that you go and take a closer look at that episode, just to refresh your memory there. If we then continue to a much smaller financial company, then Synchrony Financial have also delivered a quarterly update, and we are seeing here that this is a bit more mixed of a picture, since non-GAAP earnings per share are beating analyst estimates, but GAAP earnings per share are missing analyst estimates. But we still see a beat on the revenue, hence the stock was actually still rewarded. Now let's take a closer look at my portfolio and see what has happened within the last couple of weeks. So this is how my portfolio looked last Sunday, where I unfortunately didn't make an episode. So just to show what the result was there, at that point my value of the portfolio was $60,200. And if we compare that number with how the portfolio looked this week, we can see that the portfolio has actually increased a little in value since then, but that is cheating a bit, since I have added $500, since you can see that my costs have increased. So whether or not I should put a green or red circle for today's episode, I have decided to go with a green circle simply because of the fact that the portfolio value today is larger than it was 14 days ago, even though that I subtract the $500 which have added in an extra capital in this week. Last week I didn't buy anything at all. I was simply just letting my portfolio doing its thing and trying to do the heavy lifting. So one obvious question would of course be, well, have you added more to your Bank of America holding, since you are a big fan of Warren Buffett, and when he is going and buying for more than 800 million, then perhaps you would consider adding more into that position? And surprisingly, my answer is actually no at this point in time. Despite the fact that I really like Bank of America, I would say that I already have quite a big piece of Bank of America in my portfolio, since you can see that they actually take up more than 6% of the entire portfolio. So instead, I went in and bought for $500 in JP Morgan, since I believe that their quarterly result was really good as well, and I'm happy about the cost base which I can currently get JP Morgan at. Despite the fact that this makes my portfolio looks a little weaker, since this percentage change would have been larger if I haven't added the $500, since the new acquirement was to a higher price than my initial purchase. And you could say if I buy more Bank of America with the current price here, then I will lower my cost base, and that would look better for the overall portfolio. But simply because I want to diversify, that is my reasoning for why I'm buying JP Morgan instead of Bank of America currently, just to try and even out the big difference in the holdings. But last week I actually crossed a much more important milestone. So if we take a look at Cardinal Health, they paid a dividend of $76 last week, and Realty Income Corp paid a dividend of $4.52. And then you would say, well, what is the remark there, or why are you so happy about that? Well, if we take a closer look at the dividends tab, those two dividends made my year-to-date dividend surpassing $1,000. So this is really something that I'm happy to see, that I can now for the first time say that I have received more than $1,000 in pure dividends year-to-date. And I expect this number to grow in the future. You can see here that my estimated dividend for the entire year is a little less than $2,000, but I'm really happy to see that I'm already surpassing $1,000. So just to add more into the picture about the dividends, I will take a closer look at some of the dividend updates which I have received from the company. So if we start by Synchrony Financials, they have declared a dividend which is in line with previous, and we can see that leads to a 3.82% forward yield. Then we have Suncor Energy, who has also provided a dividend which is in line with previous. I'm also really happy about that. Then we have International Paper also declaring a dividend which is in line with previous. And here we can see that actually at the current price gives a forward yield of 5.78%, which is quite high. My dividend is of course lower since I have paid a higher price for the company. Then we move on to Bank of America, who delivered this very good quarterly update, and they are declaring a dividend which is in line with previous. We have to remember that the banks currently are not allowed to raise their dividends, so I'm just happy to see when they declare a dividend which is in line with previous, because that is currently the best thing you will get from the banks, instead of, for instance, Wells Fargo, where you saw a cut of 80%. Then finally we have Realty Income Corp, who has also declared a new dividend which is close to 5% in yield. So really happy to see a lot of my companies are still holding on to their dividends. Next, I want to focus on some of the company news which I have received within the portfolio. So for instance, this email from 13th of July regarding Walt Disney, where we are seeing that Goldman Sachs are inserting or reinserting a buy statement saying that the price target should be $137, meaning that that is an upside of 15% from the current price level at which the stock is actually trading. And I'm happy to see that, because I actually bought it initially at around this price. So at least there's someone who is believing that my investment is worth that which I have initially paid. Next up we have Carnival Corporation, who has yet again raised more debt, $1.26 billion. And then we can see here that they have sold 4 ships to undisclosed buyers, and then they have postponed some of their new purchases until 2022. So they are trying everything they can in order to lower their cost basis on a monthly basis, and at the same time try to push forward all the buys that they have done. But I mean, if we take a look at the yields that they will have to pay on these notes, 10.5% and 10.125%, now we're actually trying or seeing significant interest rates being paid here. Not the best news as a stockholder. If we then move on to the most worrying news that I have seen this week regarding stocks in my portfolio, then Tailored Brands have received a notice for listing standards. So on the 22nd of July, the New York Stock Exchange sent a notification that the company is no longer in compliance with the continued listing criteria. So over a 30-day trading period, the average market capitalization should be at least 50 million, and that the average of the closing price should be at least $1. And if we then take a look at my portfolio just to see Tailored Brands, we can see here that I'm currently down 84.5%. We can see that the recent price is 60 cents on the dollar, so way below the $1 range. And they will have 18 months to do something about this, otherwise they will be delisted from the New York Stock Exchange. So that covered Yet another exciting week on the stock market. Actually, it was 2 weeks, but nonetheless, an exciting week on the stock market. And I truly believe again that this was amazing, since we saw quarterly results from the big banks being all over, all the way from the success stories from JP Morgan and Bank of America to the bottom of Wells Fargo, which dropped severely. And we can see that there are also a lot of other stuff going on in the market. For instance, this thing about tailored brands, whether or not they will be delisted. Then I was happy to see that the Disney stock has received a higher price target from Goldman Sachs. You're always happy to see a higher price target for the companies in your portfolio, since that means that other people believe that they're actually worth what you have paid for them. So remember to comment, like, and subscribe. And until I see you next Sunday, bye!